And hey there, this is Richard from No Pants Profits, and we've been talking a lot recently about sweater ventures, which is a new way for people that are not qualified or accredited. There's different words that they use for it, to invest in venture capital, to invest in companies before they hit the IPO scene. And this channel really started with the IPO scene and with Robinhood, and we're in a market right now that the IPO scene's a little weird. And we've talked about Sweater before, but we've never talked to Sweater. So we've got Jesse, who's the founder of Sweater, and we want to talk about their fund, the Cashmere Fund, Sweater, how Sweater came to be, and everything like that. So I'll let Jesse introduce himself, and then I got a couple questions that I think you all will appreciate.
All right, Richard, it's such a pleasure to be on here with you. I still remember the first video I saw when you were highlighting Sweater and you went through our workflows. And I was totally flattered that you found us and that you decided to take some time to actually review us. So I'm excited to be with you. This is great.
Yeah, so I guess the important question is, everybody's opening their stock app or their crypto app every day, and it's nothing but a bloodbath, and nobody wants to do IPOs right now or anything like that. But where do you see, now I know you didn't start in this bloodbath, but where do you see the opportunity in venture capital when the rest of the market is turning south with interest rates and other things like that?
Oh yeah, I mean, there's a lot of different ways that we could examine and break this down. I mean, first off, if you look at the opportunity from our perspective right now as a venture fund, right, and the fundamentals of being a fund and finding success as a fund, we couldn't have better timing. I mean, there are a lot of funds that were deployed before this market correction, and their portfolio companies are getting hammered right now, which means the fund itself is also getting hammered from a returns perspective. You've got another category of funds that have deployed a lot of their capital, but not all of it. And so they're going to kind of have a split, outcome between companies that are getting hurt by what's happened and those that have an opportunity to start at the bottom and grow out of it. And then you've got a different category, which is us, which we're starting kind of, I mean, we don't know if we're at the bottom or not, right? But we're starting after the markets have corrected. So you've got all the public market stuff that's happening with interest rates and the stock market corrections and everything. But those same corrections are also happening kind of in a different flavor in the private markets as well. So lots of like unicorns that, people may have heard about are having price corrections. The prices are coming down. There's more power going to the investors to be able to have, better terms and whatnot inside the companies they invest in. So from a fund's perspective, Sweater couldn't be better positioned. And we're extraordinarily grateful that all this happened right now and that it didn't happen in a year, because that really would have hurt us as a fund. So we're grateful for where we're at. But, as an investment, like you put yourself in the consumer's perspective who might invest into Sweater, venture capital as an asset class is a really interesting one, because if you think about this conceptually, we'll get kind of like broad concept here when it comes to inflation and things that, can reflect or deflect inflation. Companies that are being built with the purpose of being acquired or IPOing one day, their price point is naturally changing and growing with the inflationary environment that's out there, right? So a company that's founded today with a certain price that is purchased or acquired 5 years from now at a certain price, that certain price is going to reflect inflation, right? So it's all relative, right? So it's kind of an interesting, at least our theory is it's kind of an interesting safe haven in a way that you could put your money into a company that is going to grow with the inflationary environment and be acquired or IPO, underneath those kind of conditions. So we like to think of it that way. It's not perfect, but it's very different than putting your money into a T-bill, right? Or buying gold or, something like that. It's really a very different concept to wrap your head around.
And especially with interest rates, venture capital money generally comes with a lower cost than debt financing, correct? Especially with the way interest rates are going nowadays and different things like that. It's an interesting.
Oh yeah, it's different. I mean, like a lot of VC-backed companies, the last 3 or 4 years, 5 or 7 years probably is more accurate, have taken, many of them have taken to bringing on debt as part of their capital stack because it was so cheap. You could get money in for next to nothing. And then that would offset the need to actually take venture capital money, which takes ownership in your company, and debt does not. So with interest rates rising, if anything, I'd say that puts even more incentive to take money from venture instead of being distracted as a company to take money in debt format. So, I think there's a lot of interesting components that are coming together to help make venture a really attractive asset class, even in the middle of all this.
So Lori, your social media manager, told me about the monkey. I want to hear about the monkey. And if you know, if you don't know what I'm talking about, Sweater, about a year before they launched, created a commercial that was absolutely fantastic. I definitely recommend you check that out. And when we're talking about the monkey, we're talking about the name of Sweater and the Cashmere Fund and everything like that. But tell us about the commercial and tell us about the ideation of Sweater and things like that.
So let me give you I guess, the history behind the name. And then I'll give you a quick story about Crystal the monkey and that swing that we took on that video. So it's a little bit entertaining. So Sweater is a name, like, we knew this was 4.5 years ago. We knew that we were going to be a direct-to-consumer company. And so we wanted to be able to have something that could capture people's attention and imagination and in an interesting way. And the thing about Sweater as a name, like, conceptually, we look at it and we say, well, we wanted to pick something that was a common word. We wanted something that was approachable. And the thing about a sweater is that everybody owns a sweater. It doesn't matter if you're rich or poor, old or young, where you live in the world, everybody knows a sweater. It's easy to translate. It's warm, it's approachable. It's like all these things that we kind of wanted to imply in our brand. And so, like, that was like the primary purpose. But then there's this secondary purpose, or I guess effect of this kind of a name. And that is, when it comes to marketing, it's a great trigger, because there are sweaters everywhere. Every time that Kohl's runs an ad that says sweater 42 times, people that have heard of us are naturally getting this ping in their life from all these other areas when you talk about sweater. And so we get to own this little category in people's lives that has never really been taken by a brand before in this kind of a way. And so for us, it was brilliant, and it was really easy. But at first, we were kind of not standoffish, but kind of arm's length with how obvious we were about it. So we went with more of like an outdoor theme, and mountains and forests and stuff like that, like places you would use sweaters, that that sort of thing. But when we launched, we found out that people just loved it, like sweaters, and like being obvious and having all the sweater puns, and we're a tight-knit community, and like all these things, and people just loved it. And so we decided to just lean into it, and we are Sweater, and it's exactly who we are.
And I'm in South Florida. We use a sweater like 3 days a year. So I'm outside of that. I'm outside of that marketing concept. I just wear Hawaiian shirts. Sweaters aren't really a thing down here. But
hey, you know what?
That might be the outlier.
Yeah. Okay. We have some jokes about creating a sweater lineup for our more tropical customers, tank tops and bikinis and stuff. But we'll see if we ever get there.
so yeah, the monkey. I don't think that's been discussed before. But
okay. All right. So the monkey. All right. So let me just tell you a quick story. And this is where it gets kind of fun. All right. So we know that we're going out into the world, direct to consumer. We know that we're, in a way, competing against other VC funds. There's all kinds of stereotypes about VCs and everything else. We're a young company. We don't have a lot of resources. We need to capture people's attention and imagination. And we also need to communicate something that's kind of complicated, for a lot of people that aren't familiar with this asset. And so we went to a group that were friends of ours that kind of specialize in this sort of thing. And we were ideating what we could do. And they came to us with 3 ideas. And it was kind of like mild, medium, and hot. And we were examining, like, from a risk perspective and like an edgy perspective. And I remember this conversation, we're sitting in this boardroom after they pitched us these ideas, and we're like, it's probably the safe thing to go with this mild version. It's, explains it well and whatever. But this spicy one, it was like, but that was the only one that got me to laugh out loud, like belly laughed out loud on my first impression. But it was edgy, and we were making fun of venture capitalists and all the stereotypes and being wealthy and like burning capital, burning money, and like all this stuff. And we were like, you know what? We need to swing hard to make sure we don't get a false negative. So if we swing like this and we don't capture people's attention, then maybe people don't want this. But if we went for the mild one and we missed, we'll always wonder, if we had just swung a little harder, whether or not we would have connected with the ball. And so we decided to go with the spicy one. And part of that was having a monkey that was in the middle of it all. And her name's Crystal, and she's fantastic. They brought her up from California. She's been in $2 billion worth of movies. So she's the monkey that's in Night at the Museum and like all these other movies.
She's like that monkey. She's the Night at the Museum
She's
monkey.
Literally that monkey. Yeah. The one that slaps Ben Stiller. Yeah. So I got to hold her on my shoulder and play with her, and anyway, so we wanted to capture people's attentions and also like capture their hearts, and I think that we've done a good job of that so far.
Yeah, no, and it's interesting because you're really focusing with the Cashmere Fund, at least, which I guess cashmere is just a type of sweater, on the direct to consumer, and you're really looking at kind of the future of the consumer. I think that's kind of the interesting theme that I've seen. You're looking at the future of the consumer, as well as, and I think one of the things is technology reducing friction. Everything from giving your kid a head start. I think one of the weirdest stories for me is about a year ago on my big stock account. I decided I wanted to get leverage on it, and they asked, how long have you been investing? And I'm 35 years old, and I said, I've been investing since I'm 3 years old. And they held up my application for 6 months because they're like, someone who's been investing since they're 3 can't use leverage. But I've been saying I like Disney, I like those other things. So or what's the name of the one for kids in education? It's killing me right now. The investing one. Early
You're
bird.
talking about,
So like
our portfolio. Yeah.
yeah, I'm talking about your portfolio, but like early bird is something to kind of get things started there. And you're kind of like from a cradle to grave. It's or cradle to
Literally.
cremation. Cradle to cremation. We don't do graves yet, but you're looking at a cradle to cremation of the whole human life cycle. And it looks like, the way you're trying to curate this and the way you're trying to set this up is more of a cradle to grave of the next generation, and reducing friction, and even things, all of the companies, the IQ bar and the Nomatica and all of those like that, really helping with that. And I think the one that I didn't get at first, I'll tell you, the weirdest company I just didn't get was Feet. We're talking, just to give everybody a timeline, it's Friday the 16th of September 2022. So we're just talking about the first 10 or so companies you've gotten there. But Feet made no sense until I realized people don't want to go back to the office wearing work clothes. They want to go back to the office. That's the reality of what Feet is.
Exactly.
And it kind of clicked. And I was like, well, that makes perfect sense. Now, is that what you're trying to do, is kind of reduce friction from cradle to grave for a consumer perspective, and make money on that, obviously?
Oh yeah, I mean, that's definitely part of the trend. I mean, the pandemic in general created a lot of behavioral changes in the broader population, and a lot of those are just coming to bear, right? And our needs are being met in a different way, in a way that we probably never really imagined, or that like we don't call out in our own heads, but we're attracted to different things now than we were a few years ago. And so companies like Feed are a great example where, it's like, yeah, my life is different, and the expectations at the office are different. Everything is different, right? So now what is my new life when I'm working at the office 1 or 2 days a week, but I'm at home the rest of the time? I got to look good on Zoom meetings, but I'm also lounging around on my couch while I'm sitting on my laptop. I don't want to change clothes 4 times, And so, yeah, I mean, like, these consumer trends are interesting, but we consider something like the situation with Feet being permanent. That's not going away. This is a permanent cultural shift.
And neither is like Nomatica. A perfect example, kind of playing it into there, is Nomatica is your canned wine company. I think one of the great things about that is, the CEO of that company, for now, she might have to do this a little differently in the future. The CEO of that company will do virtual wine tastings. And that's a great thing. If you want to send boxes of wine to your employees that are working at home, wearing Feet, giving their kids, it's kind of like you're building a fund there that kind of all works together, kind of similar to Kevin O'Leary's Mr. Wonderful, Mr. Wonderful Fund on Shark Tank, which a lot of people have seen. Is that the overarching goal, is that everything kind of complements each other and works in the new, I hate to say this phrase, I hate this phrase personally, but the new normal. A lot of what you're doing is kind of based on and for the new normal.
Yeah. Well, I mean, like, in a way, I mean, if you step back and just consider venture capital in general, that's always what venture capital is aiming for, is that new normal, right? I mean, there's a new normal that's kind of tagged around the pandemic, post-life, right? But in general, I mean, venture capital is looking into the future. It's saying, how is life going to be different, and how are we adapting to that? How do we affect that consumer sentiment and outlook, both in a personal context as well as in a business context? And how do we find the companies that are going to help create the new normal, right? And set the standards and shape the future. And that's ultimately what we are a part of, right? So many of them, are these initial investments, they do play well together. I don't think that they'll all play well together forever. Like, we'll end up getting like a Credible, probably doesn't, like, it's the credentialing platform that like keeps track of all of your Google credentials and all these other things, right?
Right.
From a professional perspective, like that, does that go well with Nomatica? Well, maybe on the weekends while you're doing your credentialing, maybe, but like, I mean, they don't fit together, but yet it still affects people's lives. It's the future of education and credibility in the workplace, right? And we believe that
Yeah.
that whole world is totally going to get upended over the next 20 years, and that a credible is very well positioned to take advantage of it, right? So yeah, I mean, I think we can always find that angle somewhere, but it's
And
going to be a little
and
different every time.
and the question on a credible, because I think this is interesting, is a credible seems to be, and you can correct me if I'm wrong, the latest stage company Sweater has invested in so far, meaning the one with the most funds in it. Is a credible kind of designed? I'm not putting it down, I think, to be kind of an easy win for Sweater on an acquisition or something like that, because it's so far along in that it might be an acquisition target. I don't know if you
Well,
could speak to that.
it is more mature than some of the other investments. It is a little bit later stage. But I wouldn't call it an easy win either. You know, I mean, there's this concept in venture capital, they call it the venture capital funnel. And it's basically, if you take, so you have all these stages, right? So you have angel investment stage, you have a seed stage, you have Series A, Series B, Series C, Series D. And then, you know, somewhere along that life cycle, either your company is going to fail, you're going to raise more money and move to the next level, or you're going to be acquired or maybe IPO. And IPO is more rare than it ever has been. But, you know, like those are the outcomes. And so you're either moving from level to level, you're failing, or you get acquired, right? And so the further you are down that funnel, it doesn't really increase the likelihood of success at any given stage, right? It's just you're bigger, you know, and so and the outcome is bigger. So like success is relative inside venture capital, and it's kind of weird to wrap your head around, but like they are a little bit more late. They are more mature. They have a great foundation. They're well poised to do something big, but you know they still have their own challenges as well. And you know, even a company that's much earlier, you know, like looking at Nomatica, they both just have very different challenges. And so I wouldn't call it an easy win, even though we totally believe in them, you know, equally across the board.
Right.
It's just a different stage.
And then it was the first company, that was the first company in the blockchain space a little bit. Are you looking to kind of, a lot of people are still, maybe not in the crypto side, because crypto's a little weird, but in the blockchain space, is Sweater open to adding more companies in the blockchain space in the future to their portfolio?
So yeah. I mean, like, so here's our take on blockchain in general. The technology is great, and we feel that the application of it is still going through a discovery life cycle. So cryptocurrencies were really the first and original application of blockchain technology, you know, and then you start looking at other things and, you know, considering the latest craze over the last few years with NFTs, saying, you know, like, well, we can use blockchain technology in this specific application. I think NFTs have tons of potential. I don't necessarily think all that potential is wound up around digital art. I think it was an interesting way
not
to
pictures
get
of
a foot
monkeys, not even though you got a monkey, you can sell a picture of. I'm just saying.
Yeah, I mean, like some people love it, right? And you know, we place value in what we say is valuable, and so to the degree that can be held, like sure. But at this point, you know, like we're fundamentally, we believe in a strategy of picks and axes, right? So if you're not familiar with that, it's kind of like you talk about the 49ers, right? That went to California looking for gold and everything. Most people that went on that adventure and went hunting for gold in the hills didn't find anything. But you know who made really consistent money? The people
in the shops that were selling the
picks
and axes.
Yeah, they made tons of money, right? And it was very consistent. And so we talk a lot about that. Like, what are the companies that are servicing a broader trend? You know, so the marketplaces that are helping you to do things, you know, like crypto.com, or, you know, taking advantage of Coinbase, right? Coinbase is an enabler inside that crypto community and NFT community to allow those things to take place with less friction, right? So that's a really interesting investment for us. But we're not going to go and put money into Ethereum and hope that the price goes up, right? That's not, like, we're never going to do anything like that, or invest in a coin offering of, you know, any nature. So we do look at these components, and it's like, yeah, you know, like there are interesting applications of the technology, and we're very much looking at it from a picks and axes perspective, but things could change. I mean, these markets and the applications of these technology, there's always something interesting that's brewing that we just haven't seen yet. And we're always open-minded to what could be possible next.
And when you're talking about that, you know, the question that comes to is, you know, you're about, again, I don't know the exact number, but you're about 10 companies announced so far, I'd say, if I'm getting ballpark. You know, how much of a fund, I know you may not be able to give an exact percentage, has been deployed so far? I mean, I think your vision was hundreds of companies under the Sweater brand, and maybe under things other than Cashmere. You know, how much has been done so far, and are there plans for other funds other than Cashmere?
Oh yeah. So let me paint the picture a little bit. So the Cashmere Fund is our first fund, and we do plan on having additional funds that will have more specific themes around them, right? Like maybe one day we do have like a crypto and Web3, and blockchain focused fund. And if you really believe in that, you put your money in that space, and that's all that we will invest in, right? Or
And
something like
question, the
climate tech.
people that are investing right now, I don't mean to stop you, but the people that are investing right now in that spectrum, would they be able to say, okay, if there's 3 funds, you could take my existing investment and put it across the 3 funds equally, or would they need to make a new investment to do those things?
It would probably be a new investment.
Okay.
Because I mean, like, there is some liquidity or some ability to move money a little bit, but it's slow going and there are some constraints around it. So with time, you could move your money theoretically and put it into another fund, and that would be possible, but you wouldn't be able to snap your fingers and do it, right?
Right.
But something that we will build into that capability is for like your monthly subscription, you're putting in $200 a month or $2,000 a month or whatever. You could take that subscription and split it between any of our different funds and continue to grow your position automatically that way as well. So, we'll end up having themed funds, and we'll have a whole umbrella of funds, and underneath each fund will have its own strategy and everything. And we'll grow our way into that in good time. Today we're starting with the Cashmere Fund, and the Cashmere Fund my goal is to have it live forever. And that's really interesting about this type of fund structure, is that it can go on in perpetuity. And so the interesting thing about, a good differentiator, I guess, between the Cashmere Fund and a traditional VC fund is that a traditional VC fund has a finite life. So when it's created, they go out and they raise money for it. They get all these commitments. There's a closing date. Everybody makes their commitments. And then the investor has about 3 years usually to deploy that money. And then that money goes into those companies. And one day, all of that will get shut down when the companies have matured and either failed or been acquired, or IPO'd, right? And then the fund is done, right? And that's the end of it. But the beginning, like most of the action happens in the first like 3 years. But the Cashmere Fund is different. It's more like a cousin to a mutual fund from an operational perspective. So we don't gather all the money up front and then have it locked in and then deploy it. We gather money as we go. And so as the money's coming in, we're deploying it at about the same rate. And so we've raised about 10 million more or less right now, and we've probably deployed about half of that. We have some reserve requirements, and we have some other strategic elements of why we would keep cash handy. But otherwise, we're kind of eating into that, right? But we're also raising money at the same time. And so it's just this ever-growing process into the future.
And you're raising money from institutional investors as well as individuals. Is that correct? Or is it just individuals right now?
It's open to institutionals, and we're talking to a lot right now, and those are big, long cycles. I mean, like, you'll talk to an institution for 18 to 24 months sometimes before you finally get through all the bureaucracy to get a check. But when you do get the check, it's a very sizable check, right? And so it's a different kind of dynamic. But yeah, I mean, anyone can invest into the Cashmere Fund. And our number one priority with that, though, is that we wanted anyone on the lower end of the scale to be able to participate at the same I guess rates and, drag and everything else as the big guys that would come into the same fund. And that's ultimately what we'll continue to do.
Yeah. And I guess the other important thing, and I don't know if this is something that Sweater has addressed as directly, but, the information that you can and cannot give out, dependent on because if you go in as a qualified investor or an accredited investor to a company, everyone at Sweater gets that information. But and I'm not saying I don't trust your team. I trust your team very much. But the information that you can't give about a company is you can only give a couple bullet points of data that they publicly made, that they've sold 6 figures worth of these things over this period of time. And kind of explaining that what you can and can't tell people. Some of it is proprietary, but some of it is actually legally you can't tell people due to the fact that you are a legitimate SEC regulated company, not a fly-by-night crypto or kind of anything like that.
Yeah, exactly. Well, I mean, I would say, start this answer by putting yourselves in the shoes of the entrepreneur, right? So you as a founder are out there, you're trying to build this company, you have competitors popping up all around you, you're a threat to people because you're coming in and kind of eating somebody else's lunch, that they've typically had, is usually the way startups work. Sometimes it's a brand new market, right? But most of the time, you're kind of taking bread out of somebody else's mouth because you're doing something better than they did. And that creates, competitive behaviors. And so to the degree that you can maintain your secrets in-house and you can maintain your momentum and these other indicators private, it just gives you that much more advantage as you're trying to overcome the odds to find success. And so you don't want that information out there floating around. And it's hard enough to keep that information within your employee base, right? Imagine if all that information was also available to our thousands of investors, right? It's just, it would make it even more difficult for that startup to find success, which is also not in the best interests of our own investor base. So we
Right.
work with the founders, and we talk about like, okay, there's some things we're just not going to talk about, right? Some founders are okay talking about certain subjects that others aren't, right? Some announce how much the value of their company was when they raised money, right? And they're totally okay talking about that because they feel like it's braggadocious and it's good for them in a way, while others would be totally resistant to it and say, no way, I don't want anyone to know how much money I just raised or what value. And some people will talk about their revenues and others won't. Some love to talk about how many users or customers they have, while others are like, no way, I don't want anyone to know. And so it's very different with everyone. And at the end of the day, we have to know everything because we're conducting very detailed due diligence on every company. And then we work with each company individually to say, what are you okay sharing? What are you not? So the information that we put into the app and that we, share eventually on the website and other places and in our videos, it's all information that's been approved by each individual company based on what they feel like they're comfortable sharing.
And when you're talking about that as well, just because there might be some people watching this who are not in Sweater yet, have not invested in Sweater yet, you actually do a call, a Zoom call, once a month or so with the investors, and go with your team, with Kara and with Sarah and everyone like that. So Kara is one of the partners, and Sarah is your director of user experience, and you go into that. But just to give an idea why you do that, so that people that might not be in Sweater yet understand that, because they don't get to see that information that the people inside already do.
Yeah, and we do hold that for our members, right? I mean, there's a different level of relationship that we have with members when they're here, and there's things and stories and context that we want you to understand because you're close, right? And we share what we can with those who aren't, because we also want people that are checking Sweater out and are thinking about participating to feel comfortable. But at the same time, there's also a level of like privilege of being a member, and we want to maintain that for members as well.
Right. Yeah. Because I'll tell you, that's a really unique thing, that you can ask questions. And I think one of the cool things a lot of people not watching, may not know, is that the founders of these companies are generally on those calls as well. The founders are represented from that company, and we had questions that your team couldn't answer, and we had the Nomatica founder jump in, and we had the founder of the Nada jump in, and all those other things like that. So I mean,
great.
that's the great thing, is really telling those founder stories. And what I'm really happy with now is I think Sweater has gotten to the level where people are starting to know what Sweater is, and now it's time to kind of tell the founder stories. And I think that's going to bring in even more people and bring in a lot more excitement.
Oh yeah, we're
kind
so
of where you guys
excited.
are headed?
Oh yeah, we're so excited to tell their stories too. I mean, so we have an in-house media team. We have two full-time media producers, and this is all they do is just create videos. So like all the videos, except for the headline videos with the monkey, we used an outside group for that.
Yeah.
But every other piece of media you see from us is from our in-house team. And part of what we want to do is take everyone along on the journeys of these founders as they go through it. Some founders are, very into that. They want to share their story. They're like the types that want to be out on the internet and do things like that. Other founders, want to build in private a little bit, right? And they just want to be able to focus. They don't want to, put their clean laundry out in the air for everyone to see, and it's just like, I've got my business, I got stuff to do. I want it to be a great success for you, right? Just don't talk to me while I'm working, So it depends, but like, we're definitely going to be telling a lot of stories. And I mean,
and some more long form content and stuff like that. Because I love some of your long form content. It's great. Like the 10-20 minute stuff instead of the 1-2 minute stuff, that really tell the story is that's what people are really into.
Oh yeah. Well, I want to emphasize this too. I mean, like, you got to compare what Sweater is doing on this front, the transparency front and the communication and the storytelling front, to the way that venture capital works right now. So the standard in venture capital today is, if you were wealthy enough to put money into a VC fund and you cut a $500,000 check or $1 million check to actually participate, here's going to be your experience. You put that money in and you aren't going to hear much, right? They may send you an email with a link to an investment that they just made. Not a lot of context, not a lot of analysis. They're not required to. On a quarterly basis, they may give you an aggregated update, maybe, but they're really only required to do that once a year. And then they'll give you like a fund overview in depth once a year with what's going on. And they'll maybe have like a little mini conference with all the investors where they could tell you about it, more about the investments. But really the purpose of that isn't for your benefit as much as it is for them to sell you to put money into their next fund. You know,
Right.
they're trying to prove credence or credibility that they did a good job so that you can fund them again. You know, and that's the underlying mojo, you know, and it's just the way it is, right? I mean, and it's not, I don't think it's anybody's fault. VC funds, they're just they don't have a lot of people. They don't have a lot of, ironically, they don't have a ton of funding to hire media people and do this kind of stuff. You know, they're pretty lean operations and they're very busy. They wear 100 hats, you know, they sit on boards and they have to talk to founders every day. And, you know, they're doing audits and they're out trying to like be active on Twitter and find new founders, and they're showing up at events and, you know, doing all these things. And so it's very difficult for them to focus on their LPs, their investors that are in their funds. So what Sweater's doing is just fundamentally like, you know, leaps and bounds above what the industry standard is as the experience of an investor in Sweater. And we want to perpetuate that and continue to enhance it over time.
And I saw something on your website, you know, based on that, was that, you know, you're looking for people to help scout new companies. Is that something that you're doing as well? That's kind of new that I've seen.
Oh yeah, and this is where it gets extra fun. So, you know, part of our ethos is that we believe everyday people should be able to participate in venture, but we also believe that everyday people have connections to incredible companies, just because of who we know, right? It's like that cousin that you haven't seen in a long time, or that roommate that you had in college, or that colleague that you worked with 5 years ago at that other company, and you hear about the things that they're doing. And, you know, it's like that effect. I got to go memorize what this effect is, but like when you're shopping for a new car, you know, and you're like, oh, I really like that new Ford Bronco. And then now you're driving around and you just see the new Ford Bronco everywhere. You're like, where do these all come from? They weren't here last week. Well, they were always there. You just weren't, you know, I guess
you weren't paying attention to them. You weren't cognizant
right?
of what was going on.
And this is the experience that we all have with startups. I mean, I think everyone would be absolutely shocked at the number of venture-backed companies and products that we interact with on a daily basis without even realizing that it's venture capital money that got them started and has helped them scale to the point that they found you, you know? And so what we're doing with the Scout Network is our belief that everyone has connections to amazing founders and companies if we just activate them to know what to look for and to realize it. And so we've got about 150 scouts right now that are actively in a community that we've vetted. We've got over 1,500 applications to join that we haven't been able to process because, I mean, even us being a venture-backed company, we don't have enough bandwidth to go and process everybody.
Right.
And we're hoping to make some changes in that. But that's the notion, right? Is that, you know, it gets everyday people involved. And one of the most interesting things that I'm very passionate about is that venture capital is a very closed community. There's definitely an inner sanctum to being in venture. And if you are inside that circle, fundraising is faster, you have great connections, you have credibility, and everything is just better for you. If you are a founder outside that circle, it is extraordinarily difficult to break in and to have that same advantage. And there's all kinds of reasons for that. Anything from like, you know, not being wealthy or not being, you know, in high social circles, like you didn't go to Harvard or whatever, right? To, you know, the color of your skin or your gender, other things that are stupid that shouldn't be holding anybody back, but they still do. And all those things combine together to create this stupid environment that makes it very difficult for even great founders to break through and obtain the attention of venture capitalists who could give them money and change the trajectory of their company. And so this is why I love the founder, the Scout Network, because it gets rid of all of that. There is no inner sanctum, right? Anyone, literally anyone, can talk to a Sweater Scout and can get the attention of Sweater. And it's never really worked like that before inside venture. And we intend to scale that to the highest level possible and see if we can, you know, maybe even become like a central clearinghouse for great opportunities so that we can be the trusted connection point between, you know, a regular founder that doesn't have good connections getting into that inner circle of venture because we are venture. Right. So we have big plans. There's lots to do.
All right, so I've got two more questions for you that have been asked to me a lot in my comment section and in people emailing me, and I kind of want to finish with these one. And they're kind of hard questions, but they're fun questions at the same time. And anybody who's watched long enough should know. So one of the questions was about the NAV. You know, the NAV has, which is the net asset value, has gone from $20 to $20.06 as of, again, September 16th. What has really moved that needle? Is it just more people getting into the fund, or has there actually been a valuation change somewhere? What has moved that needle?
Yeah, well, let me answer that question directly, and then we can have maybe a little bit broader conversation about NAV in general and how it works. So what has moved the needle to date is that we take the cash we have and it gets put into a sweep, like the account gets swept every night. So we make a small amount of interest between 5 p.m. and 7 a.m. every day that money is moved, and we actually make interest off of that. So to date, that 6 cents is just what we've made off of sweeping the account. Definitely not the long-term strategy, and not going to be what drives all the value in the fund. But it's our responsibility to make sure we do everything possible to earn every penny, right? And so that's where the 6 cents has come from, the current NAV price of $20.06. But the bigger gains come from changes in the underlying portfolio companies. So and that takes time, right? We make an investment in June of 2022. That company may not raise money again until January of 2024. Right. And in between, we have a little bit of discretion to follow their progress and see if they're trending up or down, or if they're neutral. There's a little bit of movement that we have the discretion to make. But the really big jumps, and the ones that will make a meaningful difference inside the NAV, are that next round of funding that's 18 months away. And so at the beginning of the fund, naturally that the NAV is going to move a little slowly. But as we get into it and these companies start maturing, it will start moving a lot faster.
Yeah, and then what you're going to have is, when you have 100 companies, like your goal is, you'll have movement every week, because one of those companies will do something every week. In theory, if you have hundreds of companies, you can have significantly more movement of the NAV, either up or down, given those valuations there over time.
That's exactly right.
And I guess the last thing, and this is, we'll go to something positive at the end, but this is in your prospectus is the important thing. There's a lot of funds that are coming out now that are kind of similar, that have, exit timelines. And again, I know it's in your prospectus, but it's not something that's really talked about is, okay, if I put in $10,000, let's assume that there's no gain, no loss whatsoever. I know that's the worst case scenario, but what does that $10,000 become in 6 months, 12 months, 18 months, because of the different fees and functions? And again, I recommend everybody read the prospectus, but I think it's interesting to have a discussion about that on the exit side.
Mm-hmm. No, it's absolutely right. And this is where, we hope, well, the easy way to think about it is the NAV is almost equivalent to a stock price, right? So if, you bought SpaceX in 2006, right? Well, I guess you couldn't have bought SpaceX in 2006.
Tesla. But, you bought Tesla in 2006.
You bought Tesla at their IPO in 2013 or whatever it was, right? And you hold on to that. And that price has gone up and down and all over the place. Well, how do you harvest that gain, right? Obviously there's been some great gains. You can sell your position is pretty much the only way to do it. Otherwise, you're in for the long haul, right? And you're absorbing the ups and downs. So the NAV is kind of like that price that's going up and down, except that the value of it is actually tied to real assets that are being valued and that are being audited to make sure that they're accurate. Where Tesla's stock price in the public markets, that price is driven by supply and demand of how much everybody thinks it's worth, right? Which is kind of ridiculous that it's not tied to fundamentals of the business. It's all, I don't know. I've got issues with the way that stock pricing works. But, so that NAV is tracking that over time. And so there's two ways that you can harvest over that period of time. You need to have a long-term mindset. And we try to portray this as much as possible up front before people come in, right? This is not your stock brokerage account. This is not your crypto account. There's, do not have that mentality, because you're going to be in this for a while. And because it takes a long time to build and grow companies and get them to a point where we can harvest them, right? And be able to provide that value back to you. So there's two ways that you can, harvest your position or otherwise take your gains out of Sweater. The first one is when we have an exit event. So you take Nomatica, and 3 years from now, they get a killer exit. Somebody acquires them. Now, our stock position as a fund goes from stock to cash. And that cash will come back into the fund. And everyone that is a shareholder in the Cashmere Fund will get their portion of that cash that comes back to them. And you'll have a choice. And you can choose to either take that money off the table, and that's your gain from your exposure to that stock, or you can choose to reinvest it at whatever the NAV is at that moment in time, and then you put it back into the cycle and it keeps going. So that's a choice that you have when exit events happen. And to your point that we just said earlier, the further along we get, the more frequent those exits are going to start hitting, and you'll have those choices to make. The second way you can do it is, and this is a huge innovation inside the venture capital space, is we do have these redemption windows every 6 months. And this doesn't happen in venture. Like a traditional VC fund, you put your money in, the only way you're getting that money out is when companies are sold. That's it. If a company never sells, you don't get a penny. There's nothing coming back for you, right? And there are some funds that happens, right? They're just bad funds or bad investments, or it was bad timing in the market and everybody failed. I mean, like that stuff happens. And so it's incredible that we can open up these windows every 6 months and say, hey, if you want, you can take a portion or even all of your position off the table if you want to request that. But there are limitations in how that works. So if you held onto your position for 5 years and then you decided that you wanted to take your position off the table and take some money out, and the NAV went from $20 to $40 over 5 years, and you're like, hey, I want to take some of this off. You can make that request, and then according to the kind of balancing act that we have to play, we can meet that request, and you can take some of that money out of the fund and harvest your gains that way. So, but that's the thing, like the Cashmere Fund could be alive for 20 years or 50 years or 100 years. There's no end date technically. If we had to, there are ways that we can, wind it down and end a fund.
Right.
But that's not the plan in any kind of near-term category.
And scenario one is separate from scenario two. If you get an exit, anybody can exit with their cash there at that time, correct? You don't have to wait for a window for that first scenario you were giving.
That's correct. Yeah. Yeah.
Okay.
And now I would have to go double check with fund ops. That reporting or that decision might be on like aggregated, like on a quarterly basis.
Right.
So like every exit that happened in Q4 will be aggregated, and then you have one choice at the end of that quarter to take it out or to reinvest it.
One window that you can do there. And I guess I did have one more. We talked about one of the things that I was concerned about on these meetings is, you do have Granis Ventures and Curate Capital, which are funds in funds. And, it's one of those things that I get concerned of a fund in fund, because, you'll buy, sometimes you've got fees on fees on fees on fees. So kind of discussing that, how we're not getting killed in fees with the fund in fund and the benefits of the fund in fund. And then we'll end with one fun question. But the fees on fees is a real thing, right? And that's the reason that the SEC puts a limitation that we can only have 15% of our assets in other funds. And it's for this very reason, right? They are very cognizant that there are fees on fees and that there is risk profile associated with that. We recognize it too, right? Now, if you step back and you look at, if it was really that bad, would there be dedicated fund of funds out there? Probably not, right? So like there are all kinds of dedicated funds for accredited and qualified investors. And all they do is invest all of their money, 100%, into other VC funds, and they get great returns. And the game that they're playing is they're looking at the whole spectrum of VC funds. You take 1,000 VC funds, and half of them aren't going to do that great, right? A quarter of them are going to do pretty good. And then, that 75th and 90th percentile are going to be great. And then you have the 90th percentile that are incredible. And their whole game is, what we're betting on? You give us your money, and we're going to go find the 75th percentile to 99th percentile funds, and all of your money will fall in there. And so it offsets the fees on fees part of the discussion, because you're investing in funds that are outsized, right? So in the 15% of the Cashmere Fund that we're looking at, we have the same goal. We're analyzing these fund managers saying, can they be a 75th percentile performing fund or higher? Do we believe that they have the capability, the access, the skill, the ability to assess and create a portfolio that has the ability to do that? And that's requirement number one. If we don't believe that that's possible, we're not going to make the investment. So that's absolute criteria. The next criteria we start looking at is that there are some advantages to doing this as well. One is that fund of fund managers like this are usually specialists, and they can get into nooks and crannies and interesting deals that we can't get to, right? So it gives us bigger exposure into specialized deal flow. Sometimes that deal flow and that exposure is completely indirect. They made the investment and that's all, right? Other times they'll get into an investment and they'll ask us to come along. And so we'll get exposure through their investment, and we can invest alongside them.
and they got us into a deal that we never would have seen otherwise. So those are also interesting advantages. And then I'd say that kind of the third tier is a little bit, a softer feeling for why, and it allows us to invest into causes and trends and things that we believe in, because we want to see the world become a better place in whatever way, right? So like you take Ganis, right? And they have, she has a strong focus on taking money from female investors and underrepresented investors inside her fund. So she has a strict rule that half the money has to come from underrepresented investors. And she could go out right now and she could go raise a $50 million fund from just the regular crew, but she's constraining herself because she wants to pull this other class of people in with her. We believe in that. She also has access to Latin America, right? Which is a really interesting angle for us, where we're not going to go and try to hunt down companies in Latin America, but Latin America from a technology perspective is booming right now. And so it gives us this interesting angle, and it's the same thing when you look at Curate. I mean, Curate, she's incredible, by the way. I mean, both of them are incredible, but Curate's interesting because she focuses only on women run companies that are servicing the needs of women. And this is one of the areas that we believe strongly in. Women are highly underrepresented in the greater startup community. There's only about 3%, I think, or 2.5% of venture dollars go to female founded teams, like only female founded teams, where about 65% of venture, deals are men or male founded teams only. It's a big disparity. And then you got about 25% or so that are a mix, of men and male and female teams. And so we believe in that. We want more women starting and funding companies, finding success and having support behind that. And we can't have our thesis be only that. We want to support women as well. We want to support underrepresented founders as well, but it can't be the only thing we do. So those are kind of some soft things that also get us there as well.
And then now here come the fun softball questions to finish with. And I know one of them's on the way already because I got an email. Merch, sweaters, things like that. Sweaters, those cool backpacks that I saw that are like throwback 90s Blockbuster Universal backpacks. And a lot of people have been asking about, growing this with a referral program. And I know you have had it for some influencers and things like that, but just having it for normal people. And I think those are the two things I kind of want to finish on today.
Oh yeah, no, we're excited about merch. I mean, I wasn't kidding earlier when I said that people love the whole idea of a sweater. I mean, there's something ironic about it and fun. And there's a cause, that we're supporting. I mean, like, people love it. And so we've designed a lot of stuff. I mean, this is actually one of our prototypes. This is an actual cashmere sweater, and you've got the nice logo patch that's on here. It's very professional. It's comfortable. It's pretty light. I don't know if I can wear it in Florida, maybe in like December, but it's a great feel. We've got some other stuff. Let me show you one here. This is another prototype. We went kind of university style on this one. And have this kind of a feel. We've got ball caps and all kinds of stuff that's coming. So
and I know you don't want to spoil the surprise, but I think for your founding members, there is something coming soon, because they asked me to confirm my address, and I don't think it's for a statement. Let's put it like that. I don't think it's for an account statement.
Well, we do hope that you like what you get in the mail from us. We're excited about that, and we wish that we could do something even bigger and more awesome. But we also have to be responsible with how we do this.
Yeah.
But yeah, I mean, like, kind of tying that into the referral programs and stuff. There are parameters and regulations around how we can reward people for taking actions and all that kind of stuff. But we're going to be rolling that out probably late Q4, maybe early Q1. The opportunities to actually bring other people in to discover Sweater and to earn, like credits for Sweater swag and that kind of stuff. I will say very clearly, we can't compensate anyone with cash. There's a lot of areas out there that, like, refer a friend and we'll give you $100. And
Robinhood and those crazy ones like that.
Yeah, and we can't do that. There's very strict broker dealer laws and stuff that, like, we can't go there. So never expect that from Sweater, but we are going to try to have as much fun as possible to spread the word and bring in people that, could care about this. Because the more, the bigger and stronger the community is around this, the stronger and the higher the likelihood that we can affect the outcomes of the companies we're investing in, which in turn makes your investment that much stronger, And so we're going to start portraying that story a lot more around how each individual member in Sweater can actually, affect the outcome of these companies that we're investing in.
Awesome. Well, thank you, Jesse. I want to remind everybody that No Pants Profits I'm not associated with Sweater, but when they put out a new company, I do like to do my own little review of them, and you'll see a playlist that's available there. And I'm going to continue talking with the team, and talking with their social team, and talking with Jesse, and kind of see where it goes in the future. And hopefully in the future, when we got 20, 30, 40, 50 companies, we can have another discussion in the future and see where this has all gone. So this is Richard from No Pants Profits, along with Jesse Randall, the CEO and one of the co-founders of Sweater Ventures, saying, have a good one. Bye.